Hello everyone, welcome back to the Wright Research channel. Today I want to start with a question that might sting a little. Why are most Indian investors looking only at the domestic markets for their portfolios? This is known as the home country bias. Look, India is a sunrise market, no question. We are one of the fastest growing large economies in the world, and we've built Wright Research fully around Indian equities. But NSE and BSE combined make up only about 3% of the world's total market capitalization. 3%. Which means if your portfolio is 100% domestic, you have voluntarily said no to 97% of the world's wealth creation. Today's video is about fixing that. Why 2026 is a year to think globally, how to actually do it, what the tax rules say, and where the traps are. Let's get into it. So why go global and why now? Three reasons: currency, sectors, and shock absorption. Historically, the rupee depreciates around 3 to 4% a year against the dollar. So when you hold dollar assets, even if your stock goes nowhere, you're earning 3 to 4% just from the currency. Think of it as a natural hedge portfolio insurance that pays you. Second, sectoral gaps. Be honest. Where on the NSE do you buy the companies building the future? You want semiconductor exposure. Nvidia, ASML are not listed here. You want the global tech platforms your entire life runs on. Apple is not here. Tesla and the global EV chain, not here. These are some of the most important companies of our era, and an India-only investor simply cannot own them. Third is the geopolitical whiplash. Something hits a tanker in the Strait of Hormuz. Crude whips around and our entire market wobbles. Because India imports most of its oil, our market is hostage to events happening thousands of kilometers away. A globally diversified portfolio breaks that single country dependence. When a fragile US-Iran truce or a bad monsoon impacts Indian markets, your global portfolio continues giving you returns. But you may be thinking, isn't the AI trade over? Fair question, especially if you watched our last video on the data center correction. Here's our view. The AI bubble is unlikely to burst since so much capital and time is being devoted to it. It's more like the bubble is rolling over, the money is rotating, not leaving. If we look at global markets in 2026, Japan is a standout winner. The Nikkei and Topix are up a massive 36.8% because value and industrial names are having their moment. South Korea's Kospi has corrected about 13%. Even Samsung lost around $100 billion in market value despite posting profits. Why? Because of malinvestment risk. Hyperscalers are spending billions on each other's services in a circular loop. If the returns on that capex don't show up, hardware players get hit first. The lesson here is not to avoid global. The lesson is that performance and suitability are two different things. Don't chase whichever market rallied last year. Understand the cycle and diversify across it. Interestingly, this rotation is exactly why global money is now looking at India as a diversification bet against the tech-heavy Nasdaq. Diversification works in both directions. There are three deal breakers. Global investing is not a free lunch. Three things you must know before you send a single rupee abroad. 1. Regulatory volatility. SCBI has industry-wide caps on overseas investments by mutual funds. And when those caps get hit, fund houses pause fresh subscriptions. One day your international fund SIP is running, next day it's blocked. It has happened before, it will happen again. 2. Currency reversal. That 95.39 rupee working in your favor? If the rupee suddenly appreciates, the same math runs in reverse and eats your returns. Currency is a tailwind on average, not a guarantee every year. 3. The double fee problem. Many Indian international funds are feeder funds, an Indian wrapper that invests into an offshore master fund. You pay the Indian AMC's expense ratio and the offshore fund's fees, so always check the total cost. Let's explain the taxation here, which is what everyone gets confused about. The tax collected at source under LRS. If you remit more than 10 lakh rupees abroad in a financial year for investments, 20% TCS applies on the amount above that threshold. Education and medical remittances are at 2%, education via loan is 0, and overseas tour packages are a flat 2%. But here's the key point most people miss. TCS is not a tax cost. It's fully reclaimable when you file your ITR or adjustable against your advance tax. The real issue is the liquidity lock. If you remit 20 lakhs, roughly 2 lakhs sits with the government for up to 12 months, not compounding for you. That's an opportunity cost. Plan your remittances early in the financial year and factor this into your cash flows. How to actually invest in 2026. So how do you start? Depends on your capital and involvement level. If you're a beginner, the mutual fund route is simplest. Pick globally diversified international funds and treat global as a satellite allocation, 10 to 15% of your portfolio. If you want direct control, use the LRS route. Platforms let you remit up to $250,000 per person per year and buy your Nvidias and Apples directly. More paperwork, more control. If you are an HNI, Category 3 AIFS and PMS strategies with global mandates open up. And then there's a route we are most excited about, Gift City. This is the big 2026 trend. Investing through Gift City can potentially bypass the double fee structure of traditional feeder funds entirely. It is India's own gateway to global markets, and the regulatory ecosystem there is maturing fast. The bottom line, the era of the domestic only investor is over. But go global with a strategy, not with FOMO. Here are 3 golden rules. 1. Horizon of minimum 5 to 7 years. Period. 2. Start systematic. An SIP into global exposure. Don't try to time markets. 3. Quality over hype. Balance your AI and tech exposure with value and industrial strength, the way Japan's rally is teaching us this year. Don't let the 3% trap hold your wealth back. The other 97% of the world is waiting. And a small note before I go. At Wright Research, we've been researching the space deeply, and down the line, we might offer global portfolios ourselves, possibly through Gift City as well. Nothing to announce today, but it's something we are seriously exploring. If that interests you, stay subscribed and you'll hear it here first. If this video added value, hit like, subscribe, and tell me in the comments what's the first global stock or market you would want in your portfolio. All of us at Wright read all the comments. This video is purely for education purposes and not investment advice. International investments carry currency and market risks. Please consult your advisor before investing. Invest smart, stay global. See you in the next one.